the complexity, you know, how you get away with for the big banks, if I may say so, IRB, internally rated, you know, based models. Which basically say everybody can do their own risk model because you rate it with their own risks. So why don't we have national IRBs? I mean, you know, we think that trade finance is lower, and that's my understanding of what is happening, you know, with the Chinese rules, is that in the Basel rules, with respect to the risk weight for the trade, they can actually put it lower than the actual market. Now, that's the sort of issues that you have principles based at the global level, and then, you know, much more, you know, kind of national nuance or industry nuance rules, you know, for you know, for specific areas. But sorry, let me.
I think this approach is desirable, but in some sense cannot be effective, because, you know, if we do that, then we can rationalize our decision. But then the credit rating agencies and Western financial experts will say we are intransparent, not following the, you know, global rule, and they will discount our, you know, ratings. So it's kind of, that's why it's much better Basel do some explicit say we can do that and it can solve problem. But if we do it our own way, they will criticize Asia is intransparent.
Well, maybe we should have a transparent way of dealing with this.
I was when you don't have a question.
I was just going to comment that.
Yes.
Well, that's the issue, is educating and helping them understand that it is a transparent way of doing it. And this is where I think Asia has to take the lead in educating the West on how to do it properly.
Let me just go back, because we were constrained for time, on how we see the way forward. The issue critically hinges on, if you do not, from a policy perspective, if you do not reward finance to serve the real sector, it will take a speculative leverage route. Okay? That's a heart of the policy issue. Now, how should you do this? There's one way to do this is actually what the Germans did, but unfortunately under EU rules they abandoned it. As you recall, the Mittelstand, which is the SME, was financed through a very simple discounting domestic trade bill system, right? Whereby if the bank finances a small SME for trade, that bill can be discounted with the Bundesbank, right? And of course, you know, under the EU rules, they said, no, this is discrimination, this is subsidy, etc., which I think is nonsense. I mean, you know, unfortunately, the Bundesbank has abandoned this, but I think maybe we should think about Asian central banks doing this again for particularly domestic trade, right? So that the cost of funds, you know, and then the banks will be earning the spread rather than having to pay for the funds. This first point. And secondly, you would be rewarding credit culture at the SME level, right? And then thirdly, because, you know, Asian countries are much more trade oriented, if the standardization of data and credit management can be done for both domestic and foreign trade, because it's only the identification of the user, you're going to change the whole SME financing culture bring them into the modern area rather than, you know, leaving them to their own devices, which is exactly what's happening. Okay, so the punchline is, you know, countries that have got the CMIM currency swap arrangements could actually use for example, renminbi ringgit, the renminbi rupiah swap arrangements to actually backstop trade bills. So that in the event that there was a shock that happened, actually this would ensure that the regional trade does not get killed by these external shocks.
Okay. Is there one final question from the floor? Over there. Simon.
So Simon Cox from The Economist. So much of what we've discussed has revolved around the return on equity of trade finance, its attractiveness in terms of risk-adjusted returns. But we motivated the discussion at the beginning by what happened after the Lehman shock. And Mr. Edelmann made the point that that was really a liquidity crisis. It wasn't really about default risk or really risk-adjusted returns. So I'm just wondering how much of our discussion is really addressing that acute problem of a liquidity crisis, and how much of it is just a broader discussion of the market dynamics in normal times.
that is why I emphasize this in Asia is kind of specific character, because it's liquidity, especially in dollar terms. So in Western countries, they can issue their international currencies. So it's a part of the domestic monetary policy. But here, the securing the liquidity in dollar terms is really independent of domestic monetary policy. So that's what I think Andrew is emphasizing. We have to come up with some solutions, which is maybe as a regional safety net can be one solution. But as I mentioned, it's not yet funded, so it's not that effective at this moment. And that's what I think, in my opinion, that's what the countries which can print out the international currency must be feel responsible, and they have to share the scenarios in normal times when these things happen. So it cannot be addressed by Asian countries alone. That's why this issue is related to the international financial architecture.
Maybe Andrew had a few final points.
This is a critical central banking question. Isn't it very odd that during the Lehman crisis, that Asian countries who had huge dollar reserves had to undertake a swap with the Fed? Is that an anomaly? We've got dollars, we can't use them. We have to swap it with the Fed in order to get those dollars. Now, why is that? You have to ask yourself that question, right? And the answer is actually, central banks can give as much liquidity as possible to the domestic currency. But even if you hold some of these foreign exchange reserves, you might not be able to use it, because if you lend it to your domestic banks, they lend it to the Lehman counterparties, you're dead. The money goes in, you can't come out. So actually, Asia really needs to think through the lessons of that crisis and rethink that liquidity issue. Because that liquidity issue was thought. What is the whole purpose of large foreign exchange reserves? Insurance. But at the point of insurance, you can't use that insurance reserve. Something must be wrong. You need to completely rethink this game, in order to understand. And so, what has central banks done? This time around, the same as last time around. But last time around, HKMA was scolded, lectured to use to intervene in stocks. Today you use junk bonds, right, to intervene in the market. Okay, so the game has changed so drastically that you really need to rethink the game. And we're saying, let's go back to basics. We come back to that fundamental point. We go back to basics. Use trade financing as the true collateral, which is the base for activities, and then central banks, collateralize, help finance real activities through the trade side, and then rebuild the financial system on that basis. I mean, we don't, we'll get another derivative crisis on our hands.
Thank you. On that note, let's draw things to a close. We will continue our research on trade. There's clearly a set of very important issues here, both around ongoing attractiveness and in ring fencing, but also very clear linkages to questions like R&D internationalization and the global voice, the Asian voice in global regulatory affairs. I'd like to thank the panel for their time and sharing their expertise, and then there's a good and wholesome lunch provided for you. Many thanks. Thank you for your question.